Hello everyone, welcome to today's backtest. Today's backtest is going to be on February 13th, the day before Valentine's Day. That's Friday. So all through the week, price has been consolidating. This is Monday, Tuesday, Wednesday, then Thursday, price finally moved bearish. And I said last week, I said my draw would be price taking out this buy side and also trading into this inefficiency right here on the 4 hour. And okay, this February first presented fair value gap, which didn't happen. So they decided to take price downwards on Thursday. And I still think price is still going to rally higher to take out this buy side and into the inefficiency at the 4 hour. But maybe not now. But I'm going to wait for more data from the markets on Monday and Tuesday to confirm that. So as you can see from last week, price has been on a run from this point, trading into a volume imbalance here to take out this buy side and into that level I said it's going to get to. But on reaching the buy side, it consolidated and dropped down on Thursday. Thursday's move was unexpected for so many, and some got stopped out, and while some made lots of profits on Thursday. It was like the main move for the whole week was done on Thursday. How about that? Then on Friday, price slightly moved higher. That's this indecisive candle right here. It's neither bullish nor bearish. So let's get to the market and see how this played out. And I think I did a backtest on for Thursday's trade. That's this drop right here. I did a backtest on my previous video on this. And today is going to be for on the 13th. Now, looking at the 15-minute time frame, you notice this drop down in price with this week. This is a week. Okay, the candles week. Taking out this low and this low right here. And you see the displacement at which it went back up, then traded up into this inefficiency right here. Which has a volume imbalance underneath. This is the volume imbalance. Okay, the gap between the body of these two candles, that's the volume imbalance. So price traded into this inefficiency. Okay, you can see the whole summary of what has played out on Friday. Now let's go deep and see what really played out on the smaller time frame. We get to see what really played out. Now this is how price delivered. Now we are going to see the details of how price delivered. Going to the 5-minute time frame. Okay, on the 5-minute time frame, this is still a week. A week taking out relative equal lows, sell side liquidity. Okay, and on the 5-minute time frame, what do we see? Okay, after the week takes out, okay, and it took out these lows after the market opening. So the market opening is what? 9:30, and your time zone should be set at New York. Mine is set at New York, so you get this right. So after this was the market open 9:30. Okay, no, this is 9:35. This was 9:30. This is 9:30. This candle. So after 9:30, at 9:40, price dropped down. Check out this low and this low. And actually, this day was actually CPI was released. That was my power bank falling on the ground. So like I was saying, where was I? Now I'm distracted. Okay, price taking out these lows. Okay, after the markets open at 9:40, and also today the CPI news was released at 8:30. That's this candle right here. This was the CPI news, and during the CPI, because CPI news can be really crazy sometimes. Like I was expecting, okay, maybe price to spike up. Okay, maybe to take out that buy side at the 4 hour time frame. This buy side. Okay, so at the news release of the CPI, I was expecting a spike up because that's how CPI acts sometimes. Okay, the markets might just spike up or spike down, and that's why you don't trade during high impact news hour. You don't trade 2 minutes. That's why prop firm will set their rules, like you don't trade 2 minutes before high impact news or 2 minutes after high impact news, because during those time frames, during those time range, the market can be really manipulated, and no matter your skill or whatever, you are going to get stopped out, because there are sometimes it's going to spike up, run out buy side, buy stops, and at the same time it's going to spike down to take out sell stops. So your trades are not safe at those times. Okay, you might get lucky maybe sometimes, but that's the biggest form of gamble you can ever be involved in, trading the forex market or the futures market, crypto, whatever. Now back down to the 5 minute time frame. I'll drop down to the 1 minute time frame after this. Okay, now you see price taking out these lows, okay, at 9:40, and you see this consecutive this down close consecutive candles, this down close consecutive candle, and this down close candle, and this down close candle. Okay, these are down close consecutive candles. Then after the drop down, okay, it was an up close candle followed by another up close candle. Now this is an order block. Down close candles, then up close candle. So this is an order block. This also is another block. So let's take it from here. This is another block. And you see price trading into it, respecting it. And for a high probability order block, you don't want price below the trading and closing below the midpoints of the order block. So let's get the midpoint of this order block. This is my feed. See this red line, that's the midpoint of this order block right here. See how price respects it. That's what you want. And okay, why price traded into the other block? Okay, traded into it with two down close candles and followed traded up with up close candles, forming another order block. Now this is another order block. Okay, this candle and this candle, down close candles. So you anticipate price to trade into them. So I'll use the one below, and with this drop, you can see price doesn't even trade down to the midpoint of this down close candle of the other block. And as you can see, this other block was traded into twice. Let me take this off so you'll be focused on just this other block. This other block was traded into twice. Once rallied up and came back to touch the other block one more time. And this is also another other block. Okay, I'll go with this down close candle and this. Why? Because price didn't trade above the open of this candle right here. So this is not our other block. Instead, this one and this one. So So you can see this rally up. So you can see a small down close candle right here, but we can ignore that. I guess you move to a higher time frame, maybe like the 15 minutes time frame. Okay, this actually might be one. These candles might blend into one bullish candle. Okay, so this is another order block right here. Down close candle, price trading above it with up close candle, trading above the opens of these candles. So we use the one below. You see how price traded down into it, and I know price didn't trade down to the midpoint. I'm just trying to gauge the midpoint with my eye gauge. Okay, let's just draw the Fibonacci so you see. Let's draw the Fibonacci on it. Okay, you see, price didn't trade down to the midpoint of it. Even if price trades down to the midpoint of it, you don't want to see the body of the candle close below this midpoint. Okay, now that doesn't mean that if the body of the candle close below the midpoint of the other block, it's wrong. Okay, just that high probability other blocks, okay, are normally like this. Price doesn't trade and close below the midpoint of it. Price might trade below the midpoint and leave weeks below it or a week below it, then rally up with speed. That's what you want to see for the other block. So let's move to a 1 minute time frame, then we can call it a day. Okay, now on the 1 minute time frame, now you see fair value gap. Okay, now you see a fair value gap, not a wick like what you saw on the 5 minutes and 15 minutes time frames. 15-minute chart. Now you see price taking out this low and this low, taking out sell side. Okay, at 9:40, and also our first presented fair value gap was formed on the 9:40 candle, as you can see. And how's the first presented fair value gap formed? Okay, it is formed after the open of the candle, after the open of the market. Sorry, the open of the market is 9:30. So after the open of the market, the first fair value gap that is formed after 9:30 is our first presented fair value gap. Now, as you can see, this is 9:30. There's no gap anywhere at any of these candles. Okay, and also to get it right, the gap should be formed with a displacement. Okay, now you see this drop down in price. This is forming with a displacement. Okay, now you can see the gap, the low of this candle and the high of this candle. So that's how this gap was formed, and you can see price didn't even trade down into it. I mean, to be honest, if I was in this trade, after price taking out these lows and trading up with displacement, I would likely expect price to trade down into this first presented fair value gap. But if it doesn't, I'll probably find another. If it doesn't and I was fast enough to notice price is already spooling up, I'll find another entry method to go in long. So after price took out the lows, this was the fair value gap created. The low of this candle and the high of this candle. Let me make this orange because of our first presented fair value gap, and let me bring it and send it back. Okay, so this was our fair value gap created. And also, not just this, we can also spot another fair value gap right here, and even another one up here. But if you look at this price leg right here, okay, let's say price was at this level. If we were anticipating price to go down and then take a buy, we don't want to buy at a premium. Okay, we would want to buy at a discount, which is this gap right here or this gap right here. Let me explain. So on this price leg right here, okay, after price has taken out sell side liquidity and then displaced upward, okay, now from this point when you are anticipating price to go down, okay, because price has created three gaps, this one, this smaller one right here, and this one at the bottom, which I have annotated with orange, okay, and also you can see the first presented fair value gap at the top of it. Now anticipating price to go down at this point, okay, so either of these gaps to take a buy, you don't want to buy at this level, okay, at a premium, because this is premium. So from the midpoint to this high of this fib, okay, this is premium. Then from the midpoint to the low of this fib, this is discounts, okay. So we want to be buying at equilibrium, which is at the midpoint, or below equilibrium, which is discount, okay. And as you can see, price didn't trade down up down to the first presented fair value gap, or the first fair value gap is created after taking out the sell side liquidity to rally up, but instead price made use of the smaller fair value gap just above it, which is this. So there are some times whereby you might be very stubborn, okay, and you might think, okay, price will definitely trade down into this fair value gap, okay. That's not how it works. There are sometimes whereby there might be another fair value gap above it and price is going to make use of that one instead, okay. But if you are buying at this level, at this smaller fair value gap, let me use the example, let me take this off. I guess you get the point I was trying to make about the premium and discounts, buying at premium and buying at discounts. I'm looking for this too long, okay. But if you are trying to buy, let's say you are buying at this level now, okay, at this second fair value gap, at this smaller fair value gap, let's say you are buying at this fair value gap, your stop loss is not going to be at this level. No. Why? Because there's a fair value gap below it, okay. We don't know if price would later want to visit this fair value gap, because sometimes price might actually do that, okay. So price is really tricky. Price can be tricky sometimes, okay, so you have to be careful. So buying at this level, why buying at this level, you want to anticipate price to trade into this level even if price won't, okay. So your stop loss can be below this candle right here, okay, to give room for price in case price comes back to claim this fair value gap down here, you won't get stopped out. Then your profits, okay, you can see even at this high right here is up to a 2 risk to reward ratio 2.14. That's a good trade. So there are some experts, I don't really know, that may know price won't trade below this gap right here, okay, and they might set their stop loss here, okay. So I'm talking to new traders, okay. I'm actually talking to those that are still coming up, okay. If you're unsure of yourself, the best way is to set your stop loss below this level, even while buying at this fair value gap, this smaller fair value gap above this one. So I guess you get the point. And now you see price, okay, after trading into it, there was a lot of consolidation. I guess this is a high resistance trade, okay. It takes time for price finally rallied up to that inefficiency at the 15-minute time frame. This one right here. Let's see how many minutes it took. Okay, so I guess this is a smaller fair value gap, and this is a 15-minute time frame, and for each candle is 15 minutes, right? So this is 15 minutes, 1 2, that's 30, 3 4, that's 1 hour, 5 6, 1 hour 30 minutes, 7 8, that's 2 hours. It took up to 2 hours for price to rally up into this inefficiency. So sometimes for new traders, if you are in a trade like this, sometimes you might get really frustrated. Like you might get really frustrated, especially when your take profit is at this level and you've not taken any partial after all these price runs. Okay, so at a run like this, that is very close the to your target. Let's say this 15 minutes inefficiency is your target. A run like this, okay, at a run like this, if you can take something off, you should take something off the trade. Okay, now you see this drop down. This will be scary to to a lot of traders. Your so just imagine you bought this market at this gap, then your stop loss is somewhere here, then price rallied up to this point. That's up to about 2 risks to reward ratio, right? And your target is somewhere here. Let's say this is your target. So this is your target, green. Okay, so your target is somewhere here. Let's put it close. And price has traded up. Let me make this. And price has traded up to this level. You should take partial at this point. Okay, this is a good point to take partial off your trade to remove pressure from yourself, because let's say you were up $50 at this point and price dropped down close to your entry, and you are down and you are back to about $2. I mean, that would scare a lot of new traders. Then you see some after this drop down, after this move down, you see some of them trying to put their trade on break even. Okay, so in case price trades down to their entry, the trade will close in break even because of fear. But if you've taken partial from this point, about 25%, about after about 50% of your trade, that's about $25 of the trade. Okay, even if price drops down to this point, your stop loss still remains intact. Your stop loss still remains intact, or maybe a bit, but not that you're drawing your stop loss up to break even because of fear, because you are reacting to the market. So I always preach about taking partials, taking partials. I actually fell victim to not taking partial this week, and I learned my lesson from it. Now I know this is a low, this is a high resistance run. Okay, took time for trade finally rally up to the target. Okay, let's frame this as our target. Okay, by 12 p.m. But I want you to take note of the silver bullet time window, which is from 10 a.m. to 11. Now at the silver bullet time window, you can see price trading, touching the fair value gap one last time before rallying up. Okay, and still at the silver bullet time window, price actually rallies up close to this target. See this run up right here. This is not random. This happening at the silver bullet time window. It's not random. So if I see this run and I know this is happening at the silver bullet time window, this is more reason for me to take partial of the trade. So this will end our backtest session for today. If this has brought some values to you, like, subscribe, and also share this to a friend who might actually learn from this. Trust me, actually they will. So until next time, happy Valentine's.